Over the past year, the S&P 500 is up over 25%, and year to date it is up over 15%. Yet despite this, we still have some stocks that are trading close to their 52-week low, and some of these companies I would actually consider high quality companies. So in this video, we're going to be looking at 5 different dividend stocks that are currently trading very close to their 52-week low. To analyze these stocks, we'll be using my automated spreadsheets powered by Ticker Data with the Ticker Data add-on. If you'd like to get access to the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet and also access to all my pre-built automated spreadsheets, then you can head over to tickerdata.com at the link in the description. Now let's go ahead and dive in. Our first dividend stock trading on the lower end of its 52-week low is MSCI, and that again, stock ticker MSCI, trading at $479.52 per share. Now over the past year, the company's actually pretty flat. It's down by around 1.37%, but if you look at them year to date, they're actually down by about 15.23%, and in the past month alone, actually down by about 5.44%. Now, if we go ahead and jump over to my dividend breakdown spreadsheet, we'll come up here, plug in MSCI and hit enter, and you can see all this data will automatically load in thanks to Ticker Data. Now, the starting dividend yield for this company is one of the lower yielding companies we're going to look at today. It's starting at about 1.33%. But we have to put this into context. If we have a lower starting dividend yield company, if they have a high dividend growth rate, then it could be worth it. And we can see the 10-year dividend growth rate is pretty much the highest you'll see anywhere, close to about 43%, in the 5-year, over 20% at 20.49%. So they have rapidly increased those dividends at an exponential rate over the past decade and over the past 5 years. Now, part of the reason behind this is we can see they weren't really paying out any dividends prior to 2014, but in 2014 it looks like they started with around 18 cents per share, and it's now jumped all the way up to $6.40. Now, the reason they've been able to increase their dividend payouts at such a high rate is because they've increased their free cash flow at such a high rate. We can see free cash flow payout ratio only sitting at about 38.51%. And if you look at where they were in 2014, free cash flow is about $254 million, but if you look at 2023, it's now sitting at $1.15 billion. So again, this dividend growth has been backed by free cash flow growth. That's a sign of a quality dividend growth company. The dividend growth is backed by free cash flow growth. We can see that 10-year free cash flow CAGR at about 15% in the 5-year. Also 15%. That's really healthy. And so we can see the free cash flow payout ratio, again, pretty healthy range as of right now at about 38.51%, but it has been trending slightly upwards over the past few years. We can see in 2020, it's sitting at about 32, and again at about 38.5 as of right now. Now, overall, that is still a very healthy range. It means only about 38.5% of their free cash flow is being used to pay out dividends instead of reinvesting back into the business or buying back shares or paying down debt or attempting mergers and acquisitions. If we jump over to my stock screener, plug in MSCI and hit enter, again, the data will automatically load in. Now, immediately we can see there are a lot of signs pointing that this is a high quality company. We can see a lot of growth in revenue per share, earnings per share, and free cash flow per share. The growth has been very high, very predictable, and very stable. That's a really good sign. We can see the company has rapidly bought back shares over the past decade, and return on invested capital has been very high, especially in the last couple of years. And in 2023, it was basically 30%. If we jump over to the profitability sheet, something we can see is this company has very high margins. The 10-year average gross profit ratio is sitting at 78.15%, and in 2023, it was sitting at 82.34%. So we can see gross profit ratio very steady over the past decade, and in fact, we've even seen some increases. We can see double-digit growth when it comes to revenue over the past 5 years and double-digit growth in net income over the past 5 years. So this does beg the question, what's the reason for the huge sell-off we've seen over the past month and year to date? Well, if we look closely, we can see it looks like right in here, late April, there was a huge sell-off of this stock. It went from about $515 per share all the way down to about $446. Now, why was this? Well, this was a time when the company released an earnings report, and there's a couple of things we have to keep in mind. Now, before we even look at this, we have to keep in mind the two competitors for this company are going to be S&P Global and Moody's. They are the comparables for this company. So we can see in Q1, MSCI had revenues of about $680 million, which is up 14.8% year over year, but it was $6 million below estimates. Revenues included a contribution from several acquisitions, but excluding those, revenues grew by about 10.3%, which was below both S&P Global and Moody's. If we scroll down even further, one of the things we can see is operating margin declined by 320 basis points. As a result, net income grew by around 7.2% compared to S&P Global's 24.7% growth and Moody's 15.2% growth. So growth was quite a bit lower than their competitors. So while this company had typically traded at a pretty high premium, there was a sell-off due to these results. Now we have to understand the forward price to earnings for this company is still relatively high. It's sitting at about 32.98, but to put it into context, if we look at S&P Global, we can see the price to earnings for this company sitting at about 30.59, and if we look at Moody's, we can also see the price to earnings for this company sitting at about 38.07. So these are expensive companies, but keep in mind that's because the quality of them is so good. The free cash flow growth and dividend growth has been phenomenal. We can see top and bottom lines are growing, high levels of return on invested capital, and then we can see very high profit ratios. If we look at a quick dividend discount model for MSCI, we can see assuming 7.25% dividend growth and a discount rate of 8.5%, we come to a dividend discount model price per share of $549.12, which is about 14% higher than the current trading price for this company. Our second dividend stock is truly right at its 52-week low, and we can see that as McDonald's, stock ticker MCD, trading at $249.95, and its 52-week low is about $246, so it is right there at it. We can see over the past year it's down by around 14.71%, and year to date, down now around 15.71%, and if we look at them in the past month alone, down nearly 8%. Now, what are some of the problems this company is currently facing? Why is it at its 52-week low? And the first thing we can point to is inflation has been devastating for most companies in the food and restaurant industry. If we look at inflation over the past decade, from 2014 to 2024, we can see actual inflation has come in at about 31%, at least that's what it's been reported at. But if we look at how much food prices have increased for McDonald's in the past decade, it's 100%. And to put this into context, other restaurants have had to increase prices by quite a bit. We can see Taco Bell around 81%, Chipotle 75%. We can see Starbucks at about 39%. But McDonald's has had to increase their prices the most at 100%. So that food people used to get that was considered a great value is now quite a bit more expensive. And here's what's interesting about that. If we look at McDonald's profitability, we can see revenue over the past decade has not really grown. In fact, it's actually slightly declined. We can see a 10-year revenue CAGR of about -1%. In 2013, revenue was sitting at about $28.1 billion, and in 2023, it was sitting at about $25.5 billion. It's definitely not a good sign, but we can see over the past few years, it has been trending in an upwards direction. Now, if we look at earnings per share, we can actually see this has increased by a decent bit over the past decade. So how has earnings per share been able to increase when revenue has actually been decreasing? Well, we can see the gross profit ratio for McDonald's has actually gotten quite a bit better over the past decade. In 2013, gross profit ratio was about 38.79%, but if we look at 2023, it jumped all the way up to 55.62%. So we can see that 10-year average gross profit ratio at 47.7, and in 2023, 55.62. So that's a pretty dramatic increase in the profitability of this company, which is going to help them increase their earnings per share. So we can see even though they had a negative 10-year revenue CAGR, the 10-year net income CAGR actually sitting at about 4.25%. Now, if we go ahead and look at this company from a dividend perspective, MCD and hit enter, and the data will load in thanks to ticker data. Now, the starting dividend yield for this company is sitting at 2.67%. Now, here's why this is so interesting. If we jump back over to Seeking Alpha, click on dividends and click on dividend yield and scroll down, we can see the company's historic dividend yield over the past 5 years. And with their current starting dividend yield, like we saw, sitting at about 2.67%, we can see they now have the highest starting dividend yield since 2020. Now, if we look at the dividend growth rates for this company, we can see a 10-year dividend CAGR of about 7.3 and a 5-year dividend CAGR of about 7.1. So the dividend growth has been decent and it has been steady during this time period, going from around $3.12 in 2013 up to about $6.23 in 2023, and now sitting at $6.68. If we look at the free cash flow versus the dividends paid out, we can see the dividends they're paying out does take up a large chunk of the free cash flow that the company is generating. And for the most part of the past decade, free cash flow payout ratio has been sitting at around 75%. Now, it's a little bit lower in 2023. It was sitting at about 62.48%. But again, it is important to note this company uses a lot of free cash flow to pay out their dividends. If we look at the stock screener for McDonald's, we can see healthy levels of return on invested capital, and they have bought back a lot of shares over the past decade, going from around 1 billion now all the way down to under 728 million. Now, one thing I do want to touch on very briefly is the balance sheet for McDonald's. If we jump over to my balance sheet breakdown, we can see the current ratio appears to be healthy. Again, current ratio helps us have a better understanding of how the company is managing their short-term obligations, and the current ratio is simply the total current assets divided by total current liabilities. And typically, we want this to be above 1 because that means their total current assets can cover their total current liabilities. And it looks like for the past 3 years, McDonald's has been in a position where they can cover their total current liabilities. But if you look at the debt to assets ratio over the past decade, again, this is total assets divided by total debt. It helps us know how much of their total assets is being funded by debt. We can see this has been climbing up by quite a bit, and in 2022 it got as high as about 96.56%, and in 2023 it was sitting at about 89.5%. Starting to climb a little bit higher, so this is definitely something to keep your eye on. Now, if we briefly run the company through a dividend discount model, we can see, assuming a 6% dividend growth rate, which is slightly below their 5 and 10-year dividend CAGR, a discount rate of 8.5%, we come to a dividend discount model price per share of $283.23, which is about 13.3% higher than the current trading price. Our third dividend stock, very close to its 52-week low, is a popular one. That is PepsiCo, stock ticker PEP, trading at $166.44 per share. And if we look down here, the 52-week low is about $155, so it is pretty close to that range. Over the past year, down by about 10%, and year to date, down by about 2%. Now, if we look at them in the past month alone, they're actually down by close to 8%. Now, if we jump over to the dividend breakdown sheet for this company, come up here, plug in PEP and hit enter, we can see they have a starting dividend yield sitting at about 3.26%, and the 10 and 5-year dividend CAGR, both pretty similar, around 7 to 8%. So that's decent dividend growth, especially for a company that is a little bit more mature. Now, here's what you have to understand. This company is focused on rewarding its shareholders mainly with their dividend payout, and we can see that with a free cash flow payout ratio of about 84.33%. Now, this is a little bit higher than I typically like to see it, but for a very mature company like Pepsi, again, they've decided this is the best way to reward their shareholders. Now, here's what we have to understand about this. When a company is using most of their free cash flow to pay out dividends, again, they're not reinvesting back much into the business, and as a result, we're going to see slower free cash flow growth rates. We can see a 10-year free cash flow CAGR of about 1.4 and a 5-year of about 5.26%. So if we look at 2023, they generated around $8 billion in free cash flow, but they paid out about $6.7 billion in dividends. So again, dividends being paid out are taking up most of the company's free cash flow, and we can see that free cash flow payout ratio has been climbing over time, meaning we likely won't see as much dividend growth from this company moving forward. If we jump over to the stock screener sheet, we can see revenue per share really hasn't grown quite that much except for the past few years. The same is true with earnings per share, and free cash flow per share is kind of all over the place. Now, if we jump over to the profitability sheet, one thing we can see, very stable gross profit ratios. But overall, that 10-year revenue CAGR really just doesn't impress me, and the 10-year net income CAGR is not very impressive either. So for me personally, when I look at PepsiCo, I do see a company that is very stable, very mature, and focused on rewarding their shareholders with a decent starting dividend yield of about 3.26% and decent dividend growth. But I don't see a lot of growth in the future when it comes to share price appreciation and dividend growth. If we look at a dividend discount model for this company, if we assume a dividend growth rate of about 4.75% and a discount rate of about 8.5%, we come to a dividend discount model price per share of about $151.40, but I think you could argue this is a company that typically trades at a premium due to the predictability and the stability of those dividend payouts. Our fourth company is Bristol-Myers Squibb Company, stock ticker BMY, trading at $40.96, and this is another company truly right at its 52-week low. If we look at the low of the 52-week range, it's about $39.91, and if we look at them in the past year, they have dropped by quite a bit, now down around 38%. And if we look at them year to date, down over 20%. Now, this is one of the higher yielding companies that we're going to look at today. If we jump over to the dividend breakdown sheet, come up here, plug in BMY and hit enter, we can see this data will load in. Now, the starting dividend yield for this company is relatively high. It's sitting at about 5.86%. So they pay out pretty big dividends, and the free cash flow payout ratio is actually pretty healthy at about 37.5%. We can see the 10-year dividend CAGR about 5.17%, and the 5-year coming in at about 7.91%. Now, when we look at the yearly dividend payouts, you might be a little confused. The dividend payouts look like they fluctuate by quite a bit, but again, this is because we're looking at them on a yearly basis on this chart. If we actually jump back over to Seeking Alpha, click on dividends and go to dividend history, we can see on a quarterly basis, the dividend payouts actually grow pretty consistently. So the reason it's like this on a yearly basis is we can see if we scroll down, because of the timing of those dividend payouts, sometimes, for example, they have 3 dividend payouts in 2021, and in 2020, they actually had 5 dividend payouts. So again, really on a quarterly basis, those dividend payouts are actually continuing to increase or remain steady. If we jump back over to the dividend breakdown sheet, we can see free cash flow has actually grown by quite a bit over the past 5 years. Free cash flow CAGR of about 20.45% and a 10-year free cash flow CAGR of 15.45%. Again, this has led to a pretty low free cash flow payout ratio, which is definitely something I like to see. If we jump over to my stock screener spreadsheet, we can see revenue per share done a pretty good job of increasing over the past decade, and the same is true with free cash flow per share. Earnings per share has been a little bit more volatile, but again, this can be manipulated due to different accounting practices. Overall, it's done a decent job of growing. If we come down here, we can see shares outstanding have actually increased a little bit over the past 4 to 5 years, but they have been buying them back since 2020. It looks like in 2020, they actually issued more shares, which does dilute you as a shareholder, which is something you have to be aware of. Now, if we jump over to the profitability sheet, we can see a pretty steady gross profit ratio overall, and it's pretty high as well. The 10-year average is about 74%, while in 2023 it was sitting at about 76.24%. If we take a quick glance at the balance sheet, we can see things seem to be pretty healthy. Current ratio is currently at about 1.43, and the debt to assets ratio over time looks pretty healthy as well, with it currently sitting at about 43.57%. If we run this company through a dividend discount model, assuming a dividend growth rate of about 4% and a discount rate of 8.5%, we come to a dividend discount model price per share of $55.47, which is a decent bit higher than that current trading price. And then our last company is Deere & Company, stock ticker DE, trading at $381.31, and the company has a 52-week low of about $353, so it's relatively close. And we can see over the past year, shares are down by about 6.54%. Now, if we jump over to the dividend breakdown sheet, we can see I've already plugged in DE. The company has a starting dividend yield of about 1.54%. But before I dig into these metrics any further, I want to talk about why the stock is down for a moment. First off, we can see the company recently announced their latest quarter's earnings reports, and they actually reported beats on top and bottom line. Q2 GAAP earnings per share of $8.53 was a beat by about 61 cents, and revenue came in at about $15.24 billion, which is a beat by about $1.92 billion. So why is the stock down? Well, we have to understand year over year, these metrics are down pretty significantly. If we look at the three main different business segments year over year, they're all down. Look at production and precision ag net sales, down by about 15.9% year over year. If we look at small ag and turf net sales, down by about 23.2% year over year. And if we look at construction and forestry net sales, this is down by about 6.5% year over year. So pretty much down across the board. So you can see why this stock is trading down at the moment. Now, if we jump back over to our dividend breakdown sheet, we can see the story behind this company and their free cash flow has actually been pretty interesting over the past decade. We could see for the majority of 2013 through 2018, the dividends being paid out ate up the majority of their free cash flow. For example, in 2013, free cash flow of about $879 million, while dividends paid out was about $752 million. If we look at the next year, we can see free cash flow $866 million, while dividends paid out $786 million, and this trend continued through 2016. And this led to free cash flow payout ratios of around 90% for the majority of this time period. And then we can see in 2017, we really hit a rough patch. Negative free cash flow while paying out dividends. Same is true with 2018, and in 2019, free cash flow definitely did not cover those dividends paid out. But in 2020, we saw a pretty big shift. Free cash flow from this company exploded. They generated around $4.8 billion in free cash flow while paying out about $956 million in dividends. And this led to a much lower free cash flow payout ratio of just 19%. This was the best the company had seen in quite some time, and this trend continued. 2022 was a little bit rough. Free cash flow was down while dividends were up, but 2023 free cash flow easily covered those dividend payments once again and led to a free cash flow payout ratio of about 34.63%. Now, when I see this kind of free cash flow to dividends paid out chart, this leads me to believe this business is somewhat cyclical. Now, that's not necessarily always a bad thing, and in fact, if we look at Deere & Company over the past decade, we can see they have outperformed the market by being up about 321%. They've also done a good job of increasing those dividends over a 10 and 5-year time period. But for me personally, with the companies I buy, I want to see more stability and more predictability in the growth of the free cash flow. I want the stocks I buy to provide me peace of mind, and if I don't know what the free cash flow is going to look like at all the following year, it's hard for me to consider that company as an investment. Again, that's not to say that Deere & Company could be a bad investment, I just don't think it aligns with my investment philosophy. Now, if we look at the stock screener tab, one of the things I do want to point out is return on invested capital really hasn't been very impressive for this company. And in fact, if return on invested capital is lower than the weighted average cost of capital, they're actually destroying shareholder value. And we can see from 2015 to 2018, return on invested capital was really low, below 5%. That is not a good sign. Now, in the most recent years, it has been quite a bit better. We can see 2022 around 11% and 2023 around 14%, which is much more acceptable. But overall, I don't really like what I see here from a return on invested capital standpoint. Now, if we look at the balance sheet for this company, I actually do like what I see. Return on tangible assets looks good, return on equity looks good, and the ratios look very consistent over the past decade. Again, this is a good sign. And then finally, from a dividend discount model perspective, if we assume a growth rate with the dividends of about 6.75% and a discount rate of 8.5%, we come to a dividend discount model price per share of $358.68, which is actually about 6% lower than that current trading price. So there you go, those are 5 dividend stocks currently trading very close to their 52-week low. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all of that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.